Today, we've got a special property. We've got 15326 Norman Avenue in Jacksonville, Florida. Purchase price of $205,000. It has a estimated conventional financing total monthly cash flow of $107 and a total ROI of 7.30%. And if you want to see that breakdown yourself, I encourage you to right now go to jwbinventory.com. We're good. Now that we're looking good, guess what time it is, GC?
It's game time, brother.
It's game time because we're live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the Week.
Week.
I am your host, Pablo Gonzalez. With me, as always, the man that we call GC because he's got genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hey, everybody. Great to be with you.
And I teased it earlier before the call, but right now I want you to go to jwbinventory.com, download the sheet that we're going to be fiddling with today. You actually get to see past breakdowns. Download the sheet. You're able to use this for all your deal breakdowns. And as we always start this call, if you are looking to own rental income properties in your portfolio, you are in the right place. If you are trying to find out what the best property management practices is for rental property investors, you're in the right place. And if you are a real estate professional looking for an edge in the Jacksonville market and potentially a couple of extra opportunities for you and your clients, you're in the right place. The next place to go after this is chatwithjwb.com. And Greg, now it is time for our tradition. We have the Not Your Average Investor Show family in the house. Like we always say, this is an interactive show where we want you chatting with us. We already got the chat happening. Let us know where you're from because we're about to do the roll call. Put it in the chat. Converse with us throughout the call. As we're going through this property, as we're giving you updates, use the Q&A. We use your feedback to drive the show to make as much value as possible. And right now, we only got a couple people checked in, but we're going to call them out. Good morning, Leo from California. Good morning, Drew. Oh, I guess it's afternoon for Drew. Drew Barnhill in Atlanta. He's having a register. Okay. And Noah Randari from San Francisco. Noah, that's a new name. Welcome. Good to have you. Christopher Gonzaga. Good afternoon to you. Welcome. That's a new name as well. Happy to have you here. Hope that you get a ton of value on this call. And what we're going to do today is we're going to break down a typical JWB property, right? This one happens to be one of the properties that may or may not have already been sold, but it is just like the other ones that are on the market. We're going to go into the details. Greg is going to break down the usual things that we'd like to tell people about each property. And then we're going to go a little bit deeper and answer whatever questions you have. But before we get into the property, Greg, you brought up something before this call, something about a resident expense recovery. But while people are going to jwbinventory.com and downloading the sheet to play along with us here on the show, why don't you tell me what is resident expense recovery?
Yeah, it's something we have not talked about, but it's something that is a hidden source of cash flow for you as an owner. And depending on the property manager that you work with, you may be getting this hidden source of cash flow or you may not be. RER, resident expense recovery, is the income that you receive from your resident paying for expenses, basically paying you back for expenses that you fronted, right? So normally what happens, there's kind of a push and pull when it comes to property management, because when it comes to expenses, you get to a place where if something breaks in the house and it needs to be fixed right now, and it's the resident's responsibility to fix it, you get into a tough spot, because the resident might not have the $200 that it takes to fix whatever that issue is. And if the issue needs to get fixed right now, how does the issue get fixed and still make the owner whole? And if it's something that you don't think a lot about, or if you don't have the systems or the training or the relationship with your resident, then it's going to be turn out poorly. Either you're going to force that resident to pay and maybe disrupt their financial situation, and maybe lead to a poor relationship, or the owner is going to pay for it and may not get paid back. JWB over the last 15 years has really refined our process here. And we have something that really works well. And the reason why I wanted to bring it up here is because I just got an email from our team. Internally, we were talking about some of the wins on the property management side over the last month in July. And one of the wins was that we collected over $11,000 for our owners in RER, resident expense recovery. So what happens is when a resident rents a home from JWB, they are given a lease, and the lease clearly states what they're responsible for and what the owner is responsible for. Now, if something breaks in the house, we don't exactly know that minute what the cause of the break was. So we have a trusted vendor, go to the house, and that vendor determines the cause of the issue. At that point, we can understand if it's an owner expense or if it's a resident expense. If it's an owner expense, that's easy, right? The owner has to pay for it because it's an owner expense. If it's a resident expense, a lot of property management companies fall into this sticky situation. So what JWB does is the owner fronts the cost for that repair, even if it is a resident expense, even if that resident's responsible for it, so that property can get taken care of right there. So the resident feels like they are being served very well. And then what we do is we collect that rent in a very we collect that expense recovery in a very systemized and organized manner. Going for that next month, that resident, the first $50 of rent that they pay actually goes to paying back their expense recovery. That's why it's called resident expense recovery. And they pay $50 on top of their rent for each month that it takes to pay it off. And when you do it this way, it's treating the resident very well, right? It's their responsibility. They have in essence, a payment plan. The owner is treated very well because their asset is taken care of, the resident relationship is taken care of, and they get paid back within a number of months, and everybody wins. So to the tune of, let's call this, $11,000 in July that we were able to collect for owners that wouldn't have otherwise been there if we didn't have these great systems in place. That's, roughly call it $100,000 a year in cash flow that we're able to collect back to owners and still maintain wonderful relationships with residents. So thought I'd shine a little bit of light on that. It's a very cool thing that we haven't talked about in the past, but there are so many hidden things that a property management company can either do really well or not that are going to ultimately hit your bottom line.
As you're describing this, it sounds like it's kind of property management service on layaway for the resident kind of thing, right? Like I think of if I'm renting somewhere and I'm renting from an owner of a house, a small time property management outfit, something goes wrong. There's something that's happening in the house. It needs to get fixed, right? Like, let's say there's like a leak in there's some dampness in a ceiling. Who knows what happened? It needs to get fixed. As the resident, it would be very difficult to think, all right, well, I'm just going to bring in a contractor and do this and figure it out. Like you would want your landlord, you want your property manager to take care of that stuff and then square it up and figure out, like what was the cause of this? Is this because I left the window open or is this a construction defect, right? So it just kind of lubricates the transaction, makes it happen, allows for the resident experience to stay top notch and figure out the money later. But if you're dealing with like a mom and pop shop or somebody who is, if I'm my own property manager and then I got to like figure these different things out and then go chase my resident for the cash, I could see how that gets slipped through the cracks. You don't want to have that conversation. You're not tracking it. But another example of the scale of the way that JWB operates in property management, in the sense that it gets taken care of, it gets put on a layaway plan, it gets collected along with other rent. It's seamless and it's not too painful for anybody involved.
Yeah, it's the best of a less than stellar occurrence, right? Nobody likes maintenance. The resident doesn't like it if they have to pay for it. The owner doesn't like it. We don't like it. But you can make this something that's palatable and preserve that relationship with the resident so that ultimately the owner is going to win in the long run.
Yeah, without interrupting my life as a property owner.
Yes, exactly.
Right. Passive.
You sure you don't want to get out there and chase that $50 a month, Pablo, for your rental properties?
No, it's not my favorite thing to do. You know what I do want to chase is I want to chase down this property and go visit Norman Avenue. You ready?
Let's do it.
All right, let me optimize this for sound. Let me know in the chat if this is coming in clear, because right now we are being magically whisked away to 15326 Norman Avenue, Jacksonville, Florida, 32218. Let me know if you see it okay. Are there any batches in it? Is it fuzzy? I can zoom in. We got a purchase price of $205,000. It's a 3-bedroom, 2-bathroom house with a 2-car garage, a lease of 2 or 3 years of $1,275, and what you really come to this asset class for. I see Drew Barnhill telling me it's a little fuzzy, so we're going to zoom into the money right here. This is what you're buying. You're buying this $107 of total monthly cash flow and this 7.3% estimated conventional financing total ROI. GC, let's do the usual. What does this $107 in monthly cash flow represent?
I'll get that out in just 1 second, brother. Just give you a little bit of feedback. Like on the top section and the top right, there's those like blocks that are blocking out the view a little bit. I don't know if that like sharing the window or whatever is something that's, yeah, there you go.
Okay. All right, go. How
do
we look
you did there? It's minimized now, so we're good.
Great.
So yeah, the usual here, and I love talking about this each and every week because it is critical. It is the source of why rental property investing is such a win from a return on investment perspective, as well as mitigating risk. All right. That's why I love rental property investing. I can get the upside and I limit my risk. Well, the way that you limit risk, there are 2 measurements that I want you to look at. And the first one is about limiting risk, right? The first one is your positive monthly cash flow. So that line item right there, it says estimated conventional financing total monthly cash flow of $107 a month. What we're looking at here is an asset that you can acquire that you're able to take debt out on and incur additional expenses and incur property management fees and incur the mortgage cost and incur taxes and insurance and all that. You incur all these expenses and you're still able to have a positive amount of income coming in every single month from the rents that are collected due to the market that you invest in and the neighborhood that you invest in. It's such a beautiful thing to be able to incur expenses on an asset and still have the income pay you more than what the expenses were every single month. You just don't get that in other asset classes, and definitely not to the degree that you get it in rental property investing. And in other asset classes, they don't even talk about it because all they talk about is the appreciation of that asset. Here, what we're talking about here is risk mitigation. We're talking about you buying assets that every single month, they're going to pay for themselves every single month, right? That $107 a month reflects the rental income minus the principal, interest, taxes, insurance, and property management fees. Those are the things that are going to happen every single month for you. And the reason that this is more important than people really even give it credit for is risk mitigation. But think about it on a grander scale. Think about it. If you're watching this show, you're dedicating an hour to your education here and hanging out with us. You probably have plans to own more than one rental property. Well, if you go cash flow negative on this metric, this number one metric that I want you to pay attention to, if it's negative, you're setting yourself up for a liability every single month. If you own 3 or 5 or 10, that monthly liability can get into the thousands of dollars every single month. And you don't want that. So when you're getting into rental property investing, the first and most important rule is to make sure that it pays for itself. That's what's reflected in that total monthly cash flow of $107.
Rule number 1, positive cash flow. The ability for this thing to cash flow $100 a month means that you're not going negative, means that you can stack them on top of each other without without having to go into your own piggy bank every single month, right? And this is the average feeling every month. Rent comes in, you pay your typical monthly fees, and this is what you take home. A couple of things excluded from it. Greg, I want to key in on something you said, talking about other asset classes, right? And talking about how you only bet on appreciation on other asset classes. And I know what you're talking about, right? Like we've talked about how stocks, when a stock goes up, that's essentially just appreciation. There is no cash flow behind it unless it's a dividend stock. And then that's usually not a super significant thing. And you have less potential appreciation. But I'd love for you to kind of explain what you mean by this this idea that other asset classes are only appreciation.
Yeah, I think stocks, equities are the easiest example to look at. And when you're investing in the stock market, people generally look at earning between a 7 to a 9% return on investment over the long haul. If you're in the market for a long time, historically, it produces between a 7 to 9% return. And you need to look a little bit beyond that, though. 7 to 9% compared to what you're seeing here in that line right below, 7.3%. You would kind of think that that's a similar type of return, but it's absolutely not, right? In stocks, what we're talking about is the value of your stock over time going up somewhere between 7 and 9% per year on average. What I'm talking about here on this evaluation for rental properties is everything other than home price appreciation. I'm talking about positive cash flow. I'm talking about extra tax savings that you get over the stock market. And I'm talking about principal pay down, your resident paying your loan down for you. And we're still getting over 7%. So people are investing in the stock market because their sights are set on between a 7 to a 9% return over the long haul. In rental property investing, we're getting those same returns, and we haven't even talked about home price appreciation yet. Yet all of your friends and colleagues and everybody else out there is putting their money solely in the stock market. I don't get it. It's like you're totally, you're comparing apples and oranges, right? If we start to throw home price appreciation into rental property investing, then your return on investment skyrockets much higher than historically what the stock market returns for you.
Yeah. And we're going to walk through that example, but just to call it out, right? Like right now we have the appreciation rate set at 0%. This 7.3 is exactly what you just talked about. And we're going to explain it a little bit more, but essentially it's the idea that Tim Hicks said on the show not that long ago, right? This idea that as long as you got this positive cash flow, you know that somebody is at the very least paying down this debt and you're gaining equity off it just right off the bat. And then on top of that, the tax savings as well, added to the monthly cash flow, right? So why don't you tell us what the total conventional financing ROI, what is included in that figure, what's not included in that figure?
So this is a statement of how much your money is working for you. So this is the second important metric to look at. And it's an overall, how's my money performing for me? What you're taking into account there is the positive monthly cash flow, but you're adding some of the additional profit centers on top of that. And you're also adding some additional costs that you will incur over time. Doesn't happen every single month, but over time, you will incur additional costs. So the costs would be maintenance costs, vacancy costs, tenant placement fees, including closing costs into the calculation is important. So these things happen and you need to take it into account. And the best way to do it is a total return on investment. Now, you also get some benefits that aren't reflected in total monthly cash flow. Like we just talked about, tax savings, right? Uncle Sam loves rental property investing. We get additional tax breaks for rental property investments that you just don't get in other asset classes that allow you to defer taxes, which is great, right? If you can just not pay taxes today and pay them down the line, there's value in that because you keep the cash, you're able to invest it, and you're able to earn additional return on it. It's always good to defer taxes from a return on investment perspective. So you get to do that. So there's a value there, and that's included in that 7.3% estimated return on investment. You also are including principal pay down. This is this beautiful occurrence, and I've been blessed to experience this because I've been investing for 15 plus years now, where you buy a property day one, you have a resident in place, there's positive cash flow, you've got a loan with the bank, maybe it's a $100,000 loan, and after 10 years or 15 years or 20 years, 30 years, depending on your pay down plan, one day you're going to wake up and that loan is going to be completely paid off. And the majority of it, or maybe even all of it, will be because of your resident paying it down for you. The money didn't come from your bank account. It came from your resident paying your rent to you, and a portion of that going to paying off the loan for you. It's how you wake up later on down the line and you have cash flowing assets that can provide for you in retirement, maybe even before retirement, depending on where you are. So this is a hidden profit center and a lot of people don't think about, but it's real. Let me tell you, it is real and it's beautiful to have somebody else paying your loan off for you. So we include that as well. So you take some of the additional profit centers, those being tax savings, principal pay down. You include the negative items, which will happen at some point, which is maintenance costs, vacancy costs, tenant placement fees, and closing costs. You put it all together over your initial investment, and you're still able to earn over a 7% return in rental property investing. Again, not even touching any home price appreciation that can happen.
I love it, Greg. And one of the things that you brought to my attention recently that we didn't really talk about that much, so I like to ping it now, is this idea that as that debt pay down happens, as your tenant is paying off your mortgage more and more, you may start with this $107 monthly cash flow, but you're going to wake up one day and it's going to be $841 in monthly cash flow because now you don't have a loan on it anymore. And this number is going to continue to creep up to this. So when you're building out your investment plan and your retirement future, you know, you're starting off with this one because it's the 107 means that it's an asset, right? Like it's scalable. It's not a liability, but at the end of the day, what you're building up is an army of assets that are going to pay you this much, right? The total monthly cash flow after the debt is paid down, which is significantly more and allows for your quality of life at the moment that you need it in retirement, right?
Exactly, brother.
And then there's one more thing, right? There's this appreciation rate that we haven't, that we've teased a little bit, right? We have it here at 0%. It is the reason why people come to Jacksonville, as you like to say. But why do you have it here at 0%, GC? And what happens when you change it?
Yeah, well, a couple of reasons why we have it at 0%. Make no mistake, Jacksonville is known as a growth market. That means that historically, homes have appreciated here more than the national average. And it's unique to be a cash flow market and also a growth market. You just don't see it out there. So we have that going for us. We put 0% here for a couple of reasons. Number one, let's go back to where I first started getting on my soapbox here today, which was talking about how this asset compares to the other places you can put your money, right? Stock market historically performs 7 to 9%. Bonds, definitely not even close to that. Right? Other assets that are out there, typically either they're way riskier and maybe you get a higher return on investment, or they are right along the line of how safe an investment would be, but your returns are much lower than what you can get in rental properties. It's a long way of saying, listen, this asset class, even if I don't bank on any appreciation, if I go the most conservative I can here, still stacks up as a better risk-adjusted return than other alternatives for most of the investing public. So it stands on its own 2 feet, and we don't feel the need to go out here and flaunt every potential profit center on every potential evaluation. I'd much rather you be pleasantly surprised. A core value of ours is under promise and over deliver. And this is one place that we visibly live that out every single day when it comes to our return on investment. Because if you look at the 15 plus years of clients that have invested over $450 million in real estate under our management, they have all experienced greater than 0% appreciation. Sometimes it's much higher than that. The other reason why I don't include any home price appreciation on our standard calculation is because I don't know how long you're going to hold the asset. People don't understand how to evaluate home price appreciation. They either go down the path of saying that, like most people did in the beginning of the year, in the beginning of the 2000s, right? From 2001 to 2006, the market went like this, and everybody thought that the real estate market always went up in value. And they said, there's never a year that the market goes down in value. And we all saw how wrong that was with the Great Recession, right? The Great Recession and the real estate crash, 2008 to 2011, the market dropped 35%. And then people went to the other end of the spectrum and they said, I'm never going to count on home price appreciation. It's not even going to factor into my realm of thinking. Well, the problem with that is that home price appreciation actually does have a cyclical nature to it. Within a small varying degree, you can actually kind of predict what it's going to be if you give it a long enough runway. And if you have these blinders on and you don't look at what home price appreciation can do for you, you are missing out on the very biggest profit center that you will have over a full market cycle. I'm going to say that again. It is the biggest profit center. If you give it a full market cycle, it is going to make your cash flow, your tax savings, everything else, it's going to make it pale in comparison. So you're missing out on the biggest deal that could lead to your financial wealth if you don't know how to properly estimate home price appreciation. So as with most things, the way to evaluate this and to make decisions on it is to take a middle of the road approach, right? You can't say that it's always going to appreciate. You can't say that it's never going to appreciate. You can say that if you invest for a full market cycle, that the data shows you that history repeats itself. And whatever your historically accurate home price appreciation rate was over the last 30 years will most likely be what your average appreciation rate will be over the next market cycle, which is known to be between 10 to 20 years. So if you know that information, you can look and see how your market compares over the last 30 years and take that into account as far as where you're putting your money. So if you're like me and you're like the majority of our clients and you invest for a full market cycle, you can count on home price appreciation. I don't know if you're going to listen to me though. If you're an investor and you're only investing for 1 year, 2 years, 3 years, 5 years, I don't think you should put any home price appreciation into your evaluations because you're simply not buying and holding for a full market cycle at that point.
So GC, let's say we're going to listen to you and we want to take the blinders off, right? We know that there's 4.3% historical average home price appreciation in Jacksonville. Again, this is something that you can do if you go to jwbinventory.com and download this sheet, and you can fiddle with the sheet the same way as we are. I'm going to assume that I'm going to hold it for a full market cycle. I'm going to put in the historical rate of appreciation in Jacksonville, which is 4.3%, even though right now, short term, it's way more than that, right? But we're just assuming it's going to come back down to normal within a 30-year time window. You press enter, and it goes from 7.3% to 22.94%. That's a 16% increase. GC, what's going on there, man?
The beauty of smart leverage is what you're seeing here. So the beauty of the leverage that we have here, again, it pays for itself every single month. It's not risky debt that you're taking out. It's paying for itself every single month because there's positive cash flow. But you're investing in an asset that historically goes up in value if you give it enough time. When you invest and use smart debt and get leverage on an asset that goes up in value, you're able to supercharge your returns on investment. That's what's happening here. Because what happens is as the market value goes up 4% a year, you earn that return. You earn that dollar figure of whatever that 4% represents, 4.3%, whatever that represents. But that's not your return on investment because you only put a fraction into the deal. So here's an example. Let's just say that you bought a property for $100,000. If that house goes up 4% the next year, that house is now worth $104,000, and you were able to earn $4,000 from home price appreciation. If you bought it in cash, you did not use smart debt, your return on your investment is 4% from the home price appreciation because you take 4,000 divided by your initial investment, which is 100,000. 4,000 over 100,000 gets me 4%. Now, if you learn how to master smart debt, take the same exact example. The market did the same exact thing, but you learned how to master smart debt, be a very different equation. That same property, you bought it for 100,000, but you only put 25% down. You put $25,000 down instead of 100,000. You own that asset. It went up 4% in the year. You still earn 4%. You still earn $4,000 from that property value going up from 100,000 to 104,000. So you still earn 4,000. The value went up 4%. You earned $4,000, but your return on investment from the appreciation is much different. That 4,000 is now divided by your initial investment, which is 25,000. And if you do the math at home, 4,000 divided by 25,000 is a 16% return on investment. 16% plus the other profit centers gets us to roughly 23%. And that's why you see it skyrocket to roughly 23% there.
And to kind of tag back to what we were first saying, if we're going to compare this to the stock market now, right? When in the stock market, you're expecting over the long term, 7 to 8% return on investment because of appreciation. Now we're comparing apples to apples. Now we're, including our appreciation into this investment. And this to me was the big dot connector when I first first started working with you, GC, and we started the show, and I was trying to find my way of explaining why I thought everything you said was so smart and I didn't know how to explain it. This is what really tied it together, right? It's this idea that 7% is the super controlled risk adjusted return. But then if we're going to go into the risk level of stocks and, long-term investment and call a spade, then it's this idea to use the debt to supercharge it up to 23%, to add that extra 16% long-term. That really just knocks the socks off of, comparing this versus a stock portfolio or, a Vanguard fund or whatever you're going to do, which I find really, really interesting.
How different is it with this perspective that you have versus what you started? Like, I remember our initial conversations, and one of your questions was, Greg, I love what you're about, but like, I've got these friends and they're pretty smart, and they look at this and they say, listen, why would I do this for $100 a month?
Yeah.
Right. Like, yeah. That's the perspective that most people have when it comes to rental properties, but they're missing the big thing. That idea is based on like, you're investing just for cash flow, which if all you're looking at is cash flow in this thing, it's not going to make sense to invest versus the stock market, right? It's like 1%, 2% return on investment. Like, why would you do that? That's only one of 5 profit centers. The cash flow is to mitigate your risk so that you can benefit from all 5. And when you benefit from all 5, that's where this really stands out compared to the other asset classes.
Yeah. And when I think back of those conversations, right, where I would get just, confused by how intelligent my friends are and my lack of intelligence and education in this space, which has now changed thanks to you, buddy, and the community, right? Like the great questions that are being asked. And I encourage anybody that if you have questions to pop them in the Q&A. But I think back to those, and it was the idea that I did not know how to explain the adding appreciation to the overall return, and the fact that they didn't really understand property management. Like, they didn't really understand. Everybody was taking it from the standpoint of, yeah, but every year I get a new tenant, and then I go through like this tenant improvement thing, and I got to like handle all this stuff, right? So it is a combination of understanding the apples to apples comparison, and then also understanding that within the risk adjusted return is this like slew of best practices for property management that's designed to maximize the ROI and minimize the mental load or the workload of the property owner. And I would love to kind of ask you, GC, there's the common wisdom is that you put 6% here in this maintenance rate, right? But y'all have 4% here. You want to explain kind of why this isn't the usual standard number that people generally estimate for a maintenance rate?
Yeah, absolutely. This is something that we spent a lot of time thinking about and have spent over a decade tracking now. You ask, and if you see other maintenance percentages from other turnkey companies or other property management companies, usually you don't even see them, especially from property management companies. They don't even track what their maintenance is for their owners, which is crazy to me because I know the biggest pain point you have as a rental property owner is maintenance costs. Right? Maintenance and vacancy is the thing that you're going to be, if you have an issue, it's going to be with maintenance and vacancy. So as a business owner, as a standard property manager, how does it make sense to not track the thing that is going to piss your potential clients off the most? Like, that never made sense to me. You get to other turnkey providers and they're a little bit better. They put a number on there. The problem is they don't actually track the data. So it's kind of like a made up number for them. They use an industry standard number when it comes to maintenance and vacancy. If you ask other turnkey providers how they get it, ask them to show you the data, they're not going to have it. We looked at this differently and we said, listen, if we're going to be great at property management, if we're going to be great at turnkey rental property investing, we need to be great at limiting maintenance and vacancy costs. So we actually track this. So since 2011, we have tracked every dollar in and every dollar out for all properties that we have sold to clients, over 2,000 properties now. So I can just look and see, all right, what are my maintenance costs this year? How were my maintenance costs last year? This client, what is their maintenance expense? How are they doing? Right? We get this incredible insight into how clients are feeling before we even have to ask. So this data is part of our data flywheel. This is a great source of strength for owners because we're able to look at that data and make process improvements that you don't even have to tell us about, right? We're constantly evolving. In fact, we did shows early on talking about major initiatives that were going to drop maintenance and vacancy costs early this year: flex deposit, flex rent, the septic warranty program. Those were all done this year. Well, that's because we looked at this data flywheel. We looked at our maintenance costs and we said, what are the biggest opportunities for us to drive these costs down? So we do all that. We know exactly what our maintenance costs are. And we see that for new construction properties, that over the long haul, your maintenance rate is 4%. And that 4% is a percentage of the expected rents. So if you want to see how much you should expect to lose on an annual basis in this property, you'd take the rent, which on this home is $1,275, multiply that times 12, and then multiply that times 4%. And then each year, that's what I'm telling you to set aside and say, listen, it's not going to happen every single year because not all maintenance costs work that way. But over the long haul, you're going to need to set aside that amount and you're going to give it back to the property. It's going to have that expense. And that's okay because overall, even though you're going to have that expense, we're taking into account now and we're still going to be able to hit your overall return on investment.
Gregg, I love when you start talking about data flywheels, and I just find this really fascinating, right? Like the idea that you are buying into the economies of scale of somebody that has, done something 4,000 times, right? Like it's like that old Bruce Lee saying that's like, I don't fear somebody that can do 10,000 kicks. I fear somebody that's done this one kick 10,000 times, right? So the fact that you all apply this, measurement of data across a large sample size, larger than most people in the space that you're at, to then actually drive this stuff so that you can really give real life numbers and you're not just getting it from some catalog, from some like rule of thumb. You're actually hyper localizing, specifying based on the type of construction, based on the neighborhood that you're doing, what you can count on. To me, that's a really attractive.
And I got to tell you, man, I would be so scared as a business owner if we didn't have this data.
Yeah.
Like, I mean, think about this, right? Like we have all of our client returns for all of the clients. Like we produce this on a monthly basis for every client. And a big part of that is to help our clients, right? Help you manage your money, to help you see how you're performing with your money. But a big part of that is to help my team be great at client service too.
Yep.
Right. If there's an issue, we get to see the full perspective and say, oh, wow, this has been an issue for a while here. What do we need to do before that client ever reaches out to us? What do we need to do to make sure that that client is being treated right? What problem do we need to solve here? Is it happening across the board and other issues? Right. This data is like the secret sauce for us to be an incredible client service experience.
Yep. And
no other companies have it. And I'm like, I mean, we've been talking about it for, 10 plus years now. I mean, I'm not shy about the fact that we do it and we built it. It was me building it on a Google document at one point, back in the day, right? It's not this like crazy, like you don't need to be a crazy Silicon Valley guy to build something like this. It takes a commitment, and then you have to want to see the data. And most property management companies and turnkey turnkey companies just don't want to see it.
They call him GC because he gets crazy with data. You don't have to be a Silicon Valley guy. You just got to really care about the client experience. GC, let's talk about something else. Another driver of the risk mitigation that we talk about here is the Jacksonville economy. It's this like really nice balanced mix of healthcare, logistics, and fintech, and all these other things. And this house gets to benefit from one of those, from the logistics element of it. And I know that you wanted to talk about one area of logistics, which is all the different airports that Jacksonville has. You want to give us a little bit about what the Jacksonville Aviation Authority is and why it's important to investors?
Yes. So this house on Norman Avenue is located about 6 miles from Jacksonville International Airport. And I thought, one of the things I love about this show is that it is an impetus for me to continue to learn more about the market, right? And I've always known that Jacksonville International Airport is obviously a big driver of our economy, and logistics is huge for us. So the entire aviation authority and the I believe 5 airports that the aviation authority controls, I've known that was a big part of our economy, but I haven't actually looked at the data before. And so I love this show because you all make sure that I'm at the top of my game, make sure I'm prepared. So I did a little bit of the research here on the aviation authority. I found out that the aviation authority does have those 5 airports that I was talking about. It's Jacksonville International. We have 2 executive airports. Actually, we have 3 executive airports. And then we also have Cecil Spaceport, which is really fun and exciting. And as a teaser here, we were able to land the CEO of the Jacksonville Aviation Authority, Mark Van Loo, will be joining us on the show coming up in September. And I can't wait to pick his brain about Cecil Spaceport and what this is going to do for Jacksonville, for this region. I mean, it's going to be really amazing. So you guys are gonna love that. So we've got the 5 assets here for the Jacksonville Aviation Authority, $3.2 billion economic impact to the region. That was the most recent study that was done, which was actually in 2016. So I would imagine that it's much higher than 3.2 billion. But you're seeing here a huge economic driver. We have over 200 daily flights that come into Jacksonville International Airport, and there's 270 jobs that are right there. So I love highlighting the property of the week and then talking about the specific job creators that are right next door to your property, because at the end of the day, risk mitigation starts with positive cash flow. Positive cash flow means that you have residents that are working, and you want to have strong job creators in that area. And so the Jacksonville Aviation Authority is right there. It's right there for the house on Norman Avenue. And I was looking this up. Even Erin Burnett, for anybody who's a fan of her on CNN, she called Jacksonville her favorite airport. I went and back. You can Google search it. She loved it. She was talking about how there's an art studio and all of these, like, it's very beautiful when you walk inside Jacksonville International Airport. There's windows everywhere. We're putting new wings on it and all that good stuff. So it is a big deal and something I haven't shed a lot of light on in the past, but this will definitely benefit the neighborhood and the area that the owner of Norman Avenue will experience, hopefully, for the full market cycle.
Yeah, when you think about that $3.2 billion economic impact, you think about those 270 jobs at the airport, the baggage handler, the person that the check-in counter person, those are all exactly the type of blue collar jobs that live in this type of housing. And if you're gonna, people want to live close to where they work to reduce commute times. And I agree, man. I think that the Jacksonville airport is it's a little gem, right? Like, that you're going to get in and out without a lot of hassle. There's the rocking chairs when you walk in. Like lately when I'm like flying in, they got some guy playing piano and stuff like that.
I know, right?
Yeah. It over delivers kind of.
It over delivers. Jen said she likes any airport that has Chick-fil-A in it. I agree. It's especially good for my kids. They love that.
As long as you're not flying on a Sunday, I think you're going to be okay.
Good point.
All right, GC. I don't see any questions, but I think that today was a really good synthesis of everything that we like to talk about. Is this, Greg? Oh, here we go. So Cecile Jamay has a question. Don't you worry about the growing number of COVID cases in Florida due to people resisting vaccination? How are you thinking about that, Greg? Are you thinking about the growing cases of COVID in Florida, how it affects the rental property investor?
Well, and if everybody's okay, I'm going to set aside the personal feelings of all of that crazy, intense, passionate argument, right? I'm only going to look through the lens of rental property investing. If I am being very objective and only looking at the COVID effect and how that has either benefited or hurt the rental property investor, overwhelmingly, without a doubt, it has created a market dynamic that is benefiting rental property investors. And I want you to know that I say that completely keeping the emotions of how we all feel about the terrible, pandemic. And so please keep space for that. That's not the purpose of this answer. Very, very sensitive to that. However, if I'm just looking dollars and cents from a rental property investment perspective, it has done amazing things for you as a rental property investor. And the reason that I'm saying that is because all of the market dynamics are going in your favor, right? Interest rates now, because of COVID, are incredibly low, the lowest that they will ever be. The deal is the debt. meaning that if you know how to master smart debt, you're going to set yourself up for financial strength, because you get to borrow smartly at 4% interest rates for the next 30 years. Ask yourself as an investor if you can earn more than 4% on money. Most of us can do that very easily. If you have any questions, talk to my team about it. You can earn a lot more than 4% with JWB investments, right? And you can do that for 30 years if you want to keep that loan in place. People don't realize you don't get that opportunity in other countries to do that. So now interest rates are incredibly low. Capital is available. Lending is available for those who should get it. And that is the biggest driver of why this is the best time, in my opinion, to be investing. Couple that on with where we see home prices going. I have never been more certain that home prices are going to go up in the short run, call it over the next 6 to 12 months. I base that off of what months of inventory tracks, and supply and demand is the overwhelming largest driver of where pricing goes. And so your home prices are going to go up in the short run here. So low interest rates, home prices going up, you'd get to benefit from, and rents are going way up as well. Rents in Jacksonville, in our data here, are going up over 8%. We've never seen that. I have never seen interest rates being this low, capital being available. I've never been this confident that home prices are going to go up in the future, and I've never seen rents go up this high. So if we're just thinking about this lens from COVID and you're a rental property investor, this has benefited this class more than any other asset class. Now there's a spike again here in Florida. It's been made very well known. I don't think this changes what I just talked about at all, right? COVID has had a positive effect on rental property investors, and that's just undeniable.
You see something we talked about during the pandemic, right? Like during the first outbreak of the pandemic, that became pretty clear to me, is this idea that not all asset classes are built the same, even inside of rental property investing. And the idea that this specific housing offering is not an optional housing offering for anybody that actually lives in it, right? Like the idea that anybody that pays this kind of rent for this kind of house, this is the best deal that they're going to get. And it's their best living situation. This isn't somebody that is thinking, oh man, I need to upsize my home so I have like an extra room and I'm going to go rent by the beach. This is truly the best price per square foot per experience that somebody that can afford $1,400 a month in rent can get, so that their kids can be comfortable in their own room, and so that they can like live a life, right? Like this is not optional money. This is at the base of Maslow's hierarchy of like shelter, where when they're making this decision, right? So what we saw during the first outbreak was this idea that, man, even when stuff went sideways, when the economy took a pause, what you still pay for, that you have to pay for, is your food and your shelter. And you're only going to set yourself up to have much bigger costs if you don't cover that shelter cost to start, right? So while an outbreak might happen, even if we go into another shutdown, you're investing in a critical need. You're not investing in like Bitcoin or baseball cards here, right? Like this is shelter. This is where you put your sleep, the door that you lock so that you can sleep at night. And it's the last thing that anybody thinks about, not spending the little bit of money that they have in order to continue to live. You absolutely need to do it, right?
100%. It's the critical need is what you talked about. It is good to be investing in a critical need in times of catastrophe. If you're investing, you want to be investing in a critical need. Not only are you investing in a critical need, right? It's a critical need for the government. The government needs housing to work. And that's why you saw the actions that they took all along COVID here has been to keep people in their homes. And that is to your benefit. Now, obviously, there's a part of that, which is the eviction moratorium, which has been challenging for rental property investors. But largely what I'm talking about is the incredible amount of stimulus that was given to folks for them to be able to pay rent. for them to be able to pay their mortgage, right? The government is also of the same mindset that it's a critical need for housing to work. And that's what dictates a lot of the actions. So yeah, it is, it is something that the market dynamics that have resulted from COVID are strong from a rental property investment eyes.
Yeah. Yeah. And I also, taking it a step further, right? Like I think about my personal experience in COVID. When if I would have been living in Miami, I would have been living in a 900 square foot apartment, 900 square foot studio, right? Without walls, and being locked down in a studio would be the worst, right? Mm-hmm. So if we are going to go into a lockdown, people are going to want to have a 3-bedroom, 2-bathroom house or a 4-bedroom, 2-bathroom house to be locked down in, right? Like this is the most attractive place and thing to live in if this is your budget for living and this is your profile of the type of neighborhood you live in, whether you're going to work or not. And to keep this to keep rent up as a resident is imperative, only second to like food on the table, right?
You're 100% right. And then if we're talking specifically about COVID, right? COVID has helped those markets that are less dense, where homes are more affordable. And again, we're specifically talking about the COVID effect. It has also broken that leash on employees and employers that you have to be living in the place where you work. Yep. So people are migrating. The in-migration for places like Jacksonville, the state of Florida, especially the affordable places in Florida, which is Jacksonville, Texas, right? Those two states are having such high in-migration. So again, going back to the COVID effect, right? There really hasn't been an asset in a specific location that has benefited more than single family rental property investing in Jacksonville, Florida. Like, I don't have the stats to compare that across every market out there, but I'm telling you, there aren't other markets that have everything line up like it has here in Jacksonville.
Well, Cecile, I feel like you opened up a can of worms there. I mean, I'm glad it was asked, right? Because it is on the top of the minds. I hadn't really dipped into that part of my brain in a minute, right? But like it's true, right? Like the numbers in Florida are scary. As a person living in it, it's you have to consider it. I'm in Vegas for a trade show right now, right? Like the world is back to kind of changing, right? Like everybody's wearing masks again. All these things are going into place. We don't know what the new normal is, but what we have learned is that the macro trends that COVID affected happen to benefit the Jacksonville housing economy specifically really, really well. And the specific asset class within the Jacksonville economy that JWB happens to be the category king for, which is vertically integrated turnkey rental properties for a specific income class and a specific profile of neighborhood. Those are the places that are most in demand. So, that's I guess that's the answer.
Yep. I'll give you some stats on it. You're right. We have sold for the last few years around 400 homes a year, 400 turnkey properties a year. This year, again, that was 2018, 2019, 2020, right? 400 a year, roughly. This year, we'll sell 700. I mean, people realize this is the best place to put their money.
Yeah. All right. That's the best place to put your money, best place to put your time. Hopefully you agree with us. It's the Not Your Average Investor show, right? Like it's always amazing that we got 14 people on this call for an hour in the middle of a workday. Really, really appreciate everybody being a part of it. GC, what do we got coming up on Tuesday, man?
We have, isn't that where we're talking about strategic debt pay down?
That's where we're talking about strategic pay down with your boy.
To hang out with my buddy, Paul Shively from Fortune Builders.
That's right.
That's going to be, that's really timely for what we were talking about here on the Property of the Week, when we were just talking about, you were laying out like ultimately debt pay down, right? Your resident paying your loan down for you. It shows up 10 years, 15 years down the line, paying this thing off. That's where those massive cash flows come in. Well, you're actually going to see that lived out. We're going to review how this plan can actually work for you on the call with Paul Shively. He has this incredible debt calculator that I've already stolen a lot of it. He told me he made some super duper improvements for the show too. So I'm probably going to steal a lot more, and you guys can steal a lot more too. It's going to be really, really impactful for you all.
Yeah. You know what I'm excited about? Like this is one of those shows where it's crowd generated, right? Like this was asked for a couple of times in the Facebook group, right? If you're not part of the Facebook group and you want to give us suggestions on shows that you want to see, topics that you want to have addressed here on the Not Your Average Investor Show, we are here to serve people. So go to the JWB facebookgroup.com. It's jwbfacebookgroup.com. Join us in the Facebook group. We got about 3,000 other like-minded investors like yourself that are just out there trying to, reach financial independence and interact with us, give us show ideas. This is one we're bringing that is a audience generated idea. Super, super pumped up about it. Again, if you are looking to own rental properties, you are in the right place today. If you're looking for property management advice, what the best, practices for property management advice. Again, we touched on a bunch of that today. Again, if you are looking for an edge in the Jacksonville market, you're in the right place today, right? To find new deals and new opportunities because you're a real estate professional. Next place to go if you want to find out specific for you. Your next step is go to chatwithjwb.com, hop on a call with the team. We will figure out how your situation can benefit from this amazing trend of what's happening in this asset class in the Jacksonville market in particular. We're the greatest company in the world, JWB. No big deal.
Top billing.
Yeah, top billing. That's just my opinion, right? Like I'm just a really big JWB fan here. So GC, good call by you, buddy. I'll give you last word here to thank everybody and send us out.
Well, want to say thanks for everybody being on the call, especially on this call, because as some of you have mentioned in the chat so far, we've been having some issues with Zoom on some of the reminder emails. And so everybody who attended this call, I bet the vast majority of you did not get a reminder email, and you went and checked somehow to figure out, maybe you tried every URL that you ever have tried on Zoom just to find this room. Like, it was hard for you to be here. And we appreciate it. We have, I think we've corrected that issue. So we very much hope that you will be getting reminder emails for the Tuesday show and the Thursday show going forward. Thank you guys for persevering and working with us through some technical difficulties. But you should be getting an email reminder for the Tuesday show. You should get one day before, and you should get one an hour before. And if you don't, post it on the group. We'll be checking it out. But we appreciate you guys. You guys always make it special. And I hope you guys have a great weekend. We'll catch you next Tuesday.
Adios.